Tax season's here, but filing your 2024 return is just the start and just one piece of the puzzle. Now, also is a perfect time to take a look at how you can take advantage of those tax breaks and tax opportunities coming up. In today's episode, we're going to dig out the new information. Let me go get Walt.
Hey, welcome to another edition of Power Your Retirement. I'm Walter Storholt alongside Steve Smith, financial advisor and the guy that we turn to for advice and guidance on this channel when it comes to financial planning, retirement-focused material as well, all helping employees of publicly traded utilities find their way through the financial maze out there. And Steve, you've picked out a great topic for us today as we're going to be talking about taxes. And as someone who just recently filed their taxes and finally got them behind them, you're telling me I need to start focusing on 2025's taxes already. So I know that this is an important topic, but man, we couldn't get a break.
Well, the sooner we start mining out and digging out those tax breaks, the less you'll pay next year. So
that is the key that we're trying to get across to folks here. So before we dive into the nuts and bolts of the changes that have taken place in 2025, and some of these are small, these are just little increases, numbers, but we always think it's good to kind of alert people to the new opportunities out there to maybe save more or adjustments you might want to consider. Let's talk a little bit about that difference, though. What we're talking about is tax filing, what we likely all just focused on as we release this episode in April. Maybe you're still getting those last-minute tax items figured out or filing an extension, but you're doing just that, filing. What we're going to talk about and focus on a little bit today is where we start to turn the page toward tax planning. And is the difference here, Steve, just kind of one's looking back and the other's looking more current and future?
yeah, it's always good to take a look at what we just did, because you just filed and everything, and look at what's coming up, because typically there's inflation, there's more tax deductions, standard deductions, and there's all kinds of really unique things, and those from time to time get canceled even, and others go up in value. So it's always good to know what to plan for and not take a look at it on December and wonder what we should have done.
Yeah. If there's moves we can do today to make a big difference versus looking in the rearview mirror and saying, "Oh, I could have done that last year." We're going to make all the difference when it comes to saving money, not only in the short term, but as we'll illustrate in some of these things today, in the long term as well. So cover for us first, Steve, some of the basic tax changes we should be aware of for 2025. And again, just so we're clear on this, yes, you filed your 2024 taxes in 2025. We're talking about the tax year of 2025. So the current year that we're in, changes for this year that I guess people will file in 2026 for. Hopefully that doesn't make too much confusion there.
No worries. And most of this first area, just the general, this is what everybody just ended up filing, whether you filed single or married filing jointly or whatever you did, married filing separately. The main thing we want to talk about is a number that you're familiar with, because you just went through this process, or you went through it and you're holding your check like me and you won't give it up until April 15. You might be one of those as well. But 2024 married filing jointly was a $29,200 tax deduction from your income. So you could take that right off the top before you start calculating taxes. And then the secret to how the single is really processed is you just take it in half. Makes sense, right? You got two, and then you take it in half, or you take the single and double it for married. So that's pretty simple there. But what's more exciting than what we just did, hopefully you got a big fat refund. But for next year, if you didn't, you can be encouraged, because next year we're going to be able, married filing jointly, to take $30,000 off that top end income. And of course, half of that for singles.
So an $800 increase in the standard deduction this year for those married folks, and then the equivalent, I guess, would be the $400 for single filers. So that's pretty nice. And I learned something new in kind of digging around and doing research for the topic today, Steve. I didn't realize that if you're over 65, you can actually benefit from a higher standard deduction, which is pretty cool.
Yes, the seniors get a boost. If you're 65 or older, of course, as you said, in addition to the standard deduction we just went over, 2024 was $1,950 for single or head of household, and $1,550 per qualifying individual if you're married. I'm not sure why they wouldn't I don't know. Maybe you can marry more than one person in somewhere in the United States that I'm not aware of. But the way that the IRS puts it out there, per qualifying individual. So I'll let you guys interpret that. But in 2025, it does increase just a tiny little bit by $50.
Okay.
So you're dealing with just a flat 2,000, and then 1,600 per qualifying individual.
Yeah, pretty nice to be able to see that increase take place for folks in that realm. So the standard deduction wasn't the only area we saw changes get implemented for 2025. What about 401ks? And I know this will be really important to a lot of the people that view that work with you and view this material because, Steve, so many folks are saving diligently into those 401ks.
Yeah, the 401k is tied to inflation as well. Not every year do they raise it, but most years they raise it by a little bit. And their favorite number is $500 for whatever reason. The IRS the government just loves to raise it by $500. And
No matter what inflation is, that seems to be the number, right?
yeah, they tell me it's inflation, but then again, it's the exact same number, no matter how big the number gets. Nonetheless, that's the government math right there. We won't get into the debt, that's for sure.
Yeah.
But what it went from was 23,000 last year to 23,500 this year, and that's per individual. So if you're married, you can both do that. That's not some kind of blended thing. That's individual. If you have a 401k at work, or a 403b is very similar to that. If you get into those kind of things, that's usually hospitals, nonprofits, government, things like that. It's for all intents and purposes, for this number at least, it's the same. So
now, is there an important element to know here? Like if somebody likes to max out their 401k, this isn't something that's, even though it's an automatic increase in the allowable amount, it doesn't necessarily mean that they're automatically going to now be saving more. That has to usually be a manual choice for folks.
Yes, if they want to max out and they're age 50 and more, then they really need to. They can go up to $7,500 more, which is really nice. So if you add the 23,500 plus the 7,500, if they're 50 and older, they can do a full 31,000 in 2025, which is really great. One of the things I will opine on here is that a little while back they actually put an even higher catch-up amount. Okay, so I told you above 50 is that 7,500. But if you're over 60 and still working, that's key. I get that question a lot. People want to contribute even though they're not working anymore. But if they're over 60, they can add 11,250 to that 23,500, which is amazing catch up right there.
Yeah, that's awesome. But again, you've got to go into your 401k and make these higher selections. It's not an automatic bump up to like your plan's not going to automatically bump you up to max you out. You've got to go in and make that sane choice to volunteer to do that.
Yeah, and if I could take a couple minutes to go over just to give a few tips for problems, issues that I come in contact with probably on a weekly basis. So you have to go into your software usually, or if you have a really customer service type friendly HR, they'll do it for you. But most of them, you got to log into the website and you have to select a percentage and work with your advisor, person who's helping you build this retirement. Make sure that you can either put it in the Roth side or in the pre-tax side, because this 23,500 is some kind of mix of this. Okay. It could be all Roth, it could be all pre-tax. Roth just means it's after tax. Pre-tax is obviously pre-tax. So that you'll have to put in, and if you make 100,000, obviously if you start from January 1, you don't want to put out more than 23.5%, right? Because otherwise you'll overfund. The great part is most companies will catch it. They won't allow you to overfund. They'll just cut it off so that you can go to the end of the year. But one thing you want to make sure, and most companies do this as well, but they're going to give you the rest of your match. So whether it's a 3%, 6%, 12%, whatever kind of match that you get, you want to make sure that you plan that appropriately with how your HR does it. Because I have heard rumors that, sometimes if you overfund and you're done by November, you want to make sure you're getting the rest of your match that's getting applied. So
Okay.
if you're in a company that doesn't do that for some reason, you want to make sure that you plan appropriately. So like 100,000 would be 23.5% you'd want to take out.
Okay, that makes a lot of sense. That's the breakdown on 401ks. Interestingly, we saw the inflation increase in higher amounts in the 401ks, but IRAs didn't get the same treatment.
No, we're still at 7,000, and if you're over 50, you can add a catch up of $1,000. So obviously, the government likes the 401k product better, I guess.
Yeah, or it was its turn to get affected by inflation. Maybe it'll be the IRA's turn next time around. We'll see.
Yeah, it could be.
Uh, it lastly takes us to HSAs,
Mhm.
which are a little bit of the hidden secret sauce of the financial planning world, and they made some changes to those rules as well.
They did. In 2025, you can contribute 4,300 into an HSA, which is about a $150 increase, somewhere in that range from last year. And for families, the limit went up to 8,550. Obviously,
Almost,
um,
almost double.
almost double. Yeah. So the math doesn't quite work on that. I'm not sure why,
Yeah.
but but yeah, it's a nice little break, and I would say from all the ones that we've talked about, which are the most common ones, retirement breaks, standard deductions, a couple loopholes for being a little bit older and more experienced in life, uh, is the HSA. It's the one that's not understood because you need a specific type of plan to use that. There's an FSA as well, not as widely used anymore. HSA is wildly more popular, not necessarily better, but the HSA is my personal favorite. So if you can get a high deductible plan, the main reason is that you don't have to spend that 85.50 if you're a family. You can roll that over and you can even invest it. So
Yeah.
it's a really nice way to start to save for a year that's a little tough medically on your family. So that HSA is something to look into, whether it's an automatic. A lot of companies will allow you to sign up for that inside. But even if you don't have that ability and you have a high deductible plan, you can set up an HSA anywhere.
That's good to know. Is that covered in the purview of what you help people do and coach people through, Steve? Are you able to help guide somebody through setting up something like an HSA plan as part of the other planning items that you tackle?
Yeah, we have companies that we work with. It's not necessarily, it wouldn't be like my account. It would be part of that fiduciary advice that we give. And if you
Okay.
don't have something through work, and then of course, if you are investing, we're going to help you out with that as well to pick a good
Okay.
investment on that particular plan.
Excellent. Sounds like the HSA would be a big needle mover for folks. But out of all the things that we covered today with those increases, is there one of these that stands out as most important to you, to somebody to at least perk their ears up the most or to start contributing to if they haven't been in the past? Or, hey, if you can max out that 401k, making sure you're doing that extra $500, where do you see the biggest needle mover among this bunch?
Well, I always lean into the 401k because that makes you financially independent. Not only are you getting a tax break, but you're increasing your assets and preparing for retirement and becoming free from that paycheck that's coming in all the time. So I really like to lean into those. And for all of my clients and prospective clients out there, the best thing you give me for Christmas is to max out your 401k. So it's the gift that keeps on giving. So that would be my
Nice.
favorite. If I could twist your question just a little bit and say, what would be something that people miss, as
Hmm.
opposed to what's most important that they miss out on, and I see this way too frequently, is people don't do the HSA because the
Okay.
HSA is tax. It's completely is tax free as long as you use it for medical. And if you don't and get 65, you can roll it into your IRA. Okay, so it isn't lost. It's not like education where it's it's should I do that or not. It's a great one, and you can also invest it along the way. So it's a great little accelerator to if you do have a 401k, IRA, something of that nature, simple IRA. It's a great way to really boost and protect your family along the way and get the absolute best tax treatment possible.
Fantastic. Well, this is the kind of planning that Steve's going to take you through when you become a client. And as you investigate, hey, how can I put myself in a better position to succeed financially in retirement, but even before that as well? So, wherever you are along the working spectrum, especially if you're an employee of a large publicly traded utility, Steve has some just amazing programs that can help you specifically in your industry maximize your accounts. He works with all of the major companies, knows the plans inside and out, and can provide great guidance on all of those different moving parts and elements, in addition to all of these other cool things like tax planning and taking that into consideration, helping you consider HSAs and all these other auxiliary parts of the plan, in addition to the nuts and bolts of your 401k plan and similar types of plans. So if you'd like to get in touch with Steve and have an initial conversation about what that relationship looks like, how he can move that needle for you, and what the engagement would be, don't hesitate to reach out. You can go through the planning and review process. You can go to powerupyour401k.com. Great resource there. We've got it linked in the description of today's show. You can pick up Steve's book as part of the toolkit that he offers there, with lots of other great reports and information, all related to the industry and helping you better prepare financially. So that's poweryour401k.com. We've also got the phone number and more information listed in the description of today's show, so you can find all those resources easily. Steve, great breakdown today of some of these important 2025 tax changes. Maybe small, but certainly mighty in some of these as well if we take advantage of them. And we'll look forward to chatting with you again soon.
All right. Thanks, Walt. Just remember, taxes, less is always better.
I'm down with that line of thinking. Absolutely. We'll see everybody next time. Thanks for joining us. This podcast is provided by Powerhouse Financial Advisors, an independent firm with advisory services offered through Parson X Advisory Services, Inc., PAS, a federally registered investment advisor. The information provided is for informational and educational purposes only and should not be considered as personalized investment advice. PAS does not guarantee the accuracy, completeness, or suitability of this information for your specific circumstances. Investment decisions should be based on an individual's goals, time horizon, and risk tolerance. Past performance is not indicative of future results, and all investments carry a degree of risk, including the potential loss of principal. Any case studies, testimonials, or endorsements shared in this podcast are illustrative of individual experiences and may not be representative of the experience of all clients. They do not guarantee future performance or success. You should not infer any level of assurance regarding future financial outcomes. Listeners should consult with a qualified financial, tax, or legal professional before making any investment decisions. Parson X Advisory Services, Inc. does not provide tax or legal advice. Be sure to consult with your tax and legal professionals regarding your specific circumstances. For a copy of our Form ADV Part 2A, which provides additional information about PAS, including our advisory fees and services, please visit powerhousefinancialadvisors.com.